Is anywhere really safe from the risk of natural disasters these days? I mean, think back over the last year. We saw hurricanes and flooding along the East Coast, hailstorms in the Midwest, tornadoes in the South, and of course, wildfires out west. And by the way, right now, the largest insurer in California is trying to raise insurance rates by an average of 22%. And your state could be next, potentially. State Farm General says the rate increases are necessary to afford future claims as they budget for paying out more than $7.5 billion from the Los Angeles wildfires. And while rate hikes are never welcome, the alternative could be worse for millions of people in areas designated as disaster prone. If State Farm General cannot find the funding, homeowners could face losing their coverage. So for more on these increases, we are joined by Jeremy Porter, the head of climate implications for First Street, a company that provides data about climate risk to institutions. Jeremy, thank you so much for being here. So how did we get to this point where insurance companies just aren't keeping up? Haven't they been tracking climate change?
Yeah, it's a really interesting question. I think the reason why we're at this point are really two competing issues. One is the fact that climate change is driving up the costs for insurance companies. Since 2017, we've actually seen the industry as a whole be in the red, on the wrong side of breaking even. At the same time, we're seeing a lot of regulatory environments in place, especially in places like California, where there's rate suppression for consumers. They're trying to protect homeowners, making sure that rates can increase above a certain level. What we've gotten to in the last 5 to 6 years is a point at which payouts have surpassed premiums that insurance companies are bringing in. And as a result, they're asking for the regulatory environments to be relaxed.
So they can increase their prices more?
It's such an interesting way that they calculate all of this. So what happens if there's a home that's designated too high risk to be covered by private home insurance? What happens to those families, and who makes that designation?
It's the insurance company right now. If the insurance company feels like an area, they usually do it by zip code. Sometimes they go down to the property level, but they'll identify areas as being too risky to cover, given the larger regulatory environment and all of the calculations that go into the pricing. And what they'll do is they'll say, we can't provide premiums in this area because there's too much risk. It's not actuarially sound from a business perspective. And so they'll pull out of those communities. And as they pull out of those communities, they're providing homeowners with non-renewal notices. And those non-renewal notices essentially say, at the end of your term, you're not going to have insurance with State Farm, for instance, or Allstate, or whoever is pulling the insurance. And then the homeowners have to go to what's called an insurer of last resort. And so the states have the state-sponsored insurers of last resort. In California, there's an insurance program called the State Fair Plan. And the State Fair Plan oftentimes has premiums about 2 to 3 times what the private insurer.
But why wouldn't the private insurance company just raise rates to 2 to 3 times and say the risk is greater, and because of that, you have to pay a higher premium?
It's the regulatory environment. In California, to raise rates above 7%, you have to go in front of the insurance commissioner, or you have to do what's happening right now, the hearings that are taking place to raise those rates.
So in states like California, the government's saying you can't raise rates above this level. And so anyone who can't get insurance because of that then can get government subsidized rates that are higher?
They're actually higher, yeah, because they're not part of that regulatory environment. They're not being restricted to the 7% increases, so they're actually pricing risk based on what risk costs.
It seems like the homeowner is losing out.
The homeowner is losing out.
And they didn't calculate this when they bought the home, right?
And California is doing a really good job at this point of thinking about starting to integrate climate into the pricing algorithm for homeowners. That's going to mean increases in insurance costs, but to the point that I think you were about to make, homeowners didn't think about paying $2,000, $3,000 more when they took out their mortgage just 5 years ago. And for a lot of people, those household budget just don't make sense anymore.
So what do people do? Are they meant to sell their homes? And who's going to buy those homes in those areas if they can't get covered?
And don't even get us started on mortgage rates, but that's another story.
Yes. Well, we are getting to the point to where homes are losing value because of this. People, when they buy those homes, are negotiating the prices down to account for the additional costs. But we also have a record high number of people that are just going uninsured. I believe after the LA fires, we saw maybe 12% of people were uninsured. And that figure is just astronomical. In the face of not having any kind of protection, all of a sudden, it's a much bigger risk given the weather disasters.
So, Jeremy, what's your advice to people? Should we just not be living in these disaster-prone areas, which, by the way, that area is kind of widening?
Yeah, and it is widening. We've seen more damages, more severity of the weather disasters we're seeing. We're seeing them more frequently. People should be informed. I think as far as 3-4 years ago, it was really hard to find data during the home buying process on climate and weather information. what we've gotten to today is that you can go on Zillow, you can go on Redfin, you can go on Realtor, you can see information that's related to both your risk, but then also the cost of those damages. So as you're going through the home buying process, it's really important to understand your risk, going with your eyes wide open, and understand what it's going to look like in the next 10, 15, even 30 years.
What's ironic is it's deregulation that allowed homes to be built in high-risk areas, and now regulation is keeping insurance companies from properly being able to assess those premiums. It's fascinating. Jeremy Porter, thank you very much.
Thanks.
That was really interesting.